If you've been struggling with overtrading, inconsistency, and not knowing when or where to enter, this is the only setup I use to secure payouts month after month. Today, I'm breaking down exactly how I use these 3 different tools to trade with an 80% proven win rate. By the end of this video, you'll know exactly how to find high probability setups that will change your trading. So what we're going to do today is break down these 3 specific tools, and then we're going to look at one of the trades that I've caught live on my free trading streams. The first thing that we need to start with, and the foundation of every single trading strategy out there, is liquidity. So let's have a look at what that is and how I use it every single day. So a very basic understanding is that it's the lifeblood of the markets. And all you really need to understand about liquidity is that it is money. It is where money is lying in the market. Whether it's a stop loss or a pending order, whatever it is, liquidity is money, nothing else. Now, the way to find liquidity is basically just thinking about where you would put your stop loss, and that's pretty much where it would usually be, right? If you can place your stop loss decently well, you will know where liquidity is lying, okay? And in this consistent move up, a sustainable move up, in this push up here, you can see that there are highs. Now, zooming in on this, right, if you were to enter a sell position, most people would put their stop loss just around here. Like, someone put it here, someone put it here, someone put it even further maybe, right? Around this area is where you would put your stop loss. In other words, you would put money here. In other words, there is liquidity resting at this high because that is where people are going to place their stop losses. Same with this high, this low, and this low over here as well. People are putting their stop losses here and maybe even pending orders. Therefore, there is money there. Therefore, there is liquidity. Now, why am I showing you liquidity? It's great that you know what it is, but why are we even looking at it in the first place? And that is because the markets are always moving towards liquidity. Whether it's highs and lows or fair value gaps, the markets are always moving towards liquidity, okay? So liquidity is money, and the markets are always moving towards this money. In other words, the markets are always moving towards highs and lows and fair value gaps, which leads us on to our next subject. Now we're going to look at the second tool, which is fair value gaps. What are they? How do they work? And what's the point in looking at them? So first things first, what are they? They are a gap in the market where price has pushed in one direction too quickly without any form of retracement. Some people may call these LTAs. Some people may even just call them imbalances. Either way, they are the same thing. Fair value gaps is where there is a lack of fair value. There is a gap of fair value, right? And what price needs to do is come back to this gap. But first, what is it? What is a fair value gap? What does it look like? So realistically, you can look at 3 candles, okay? And I'm going to color this candle green because we're in a bullish move, but it doesn't really matter about these 2 candles here. So for a fair value gap, you need to focus on 3 candles. This one, and this one, okay? These are gray because the direction does not matter. These can both be bearish, one can be bullish, one can be bearish, or they can both be bullish. Whatever it is, it does not matter. The only thing that matters is the direction of this candle right here, and also whether or not we have a wick overlapping the top and bottom candle, right? So if we have wicks like this, we have a push up with no retracements back into this area. We have a clear gap, right? So we draw a box from here up to here, and that is simply our fair value gap. That is called a bullish fair value gap because we are pushing up, right? Self-explanatory. If we look at this right here, I'm going to do the same thing. Leave the outside candles gray because the direction simply does not matter. We're going to color the inside candle red to show that it's a bearish candlestick, right? So this is a bearish fair value gap. The reason it's bearish is because the expansion or the middle candle is bearish. And all you need to do is make sure that the wicks on the first and third candle do not overlap. This is a perfect example of a fair value gap. Now, if this wick right here was all the way up here, we wouldn't have a gap because we've came down, pushed up, pushed down, then pushed back up, then pushed back down. In other words, we've had a retracement, right? If it looks like this, this is valid. So now that we've learned what liquidity and fair value gaps are, I'm going to show you exactly how to combine those 2 things together. And then we're going to look at the third and final tool. Then we're going to look at an entry model, okay? Simple as that. So fair value gaps and liquidity. How do you use them together? Well, there's this concept called ERL. This one stands for external range liquidity, and this one stands for internal range liquidity, right? Self-explanatory. If you focus on the last words, you have external and internal, right? And now this is describing a move. So if we have a move up like this, right, followed by a retracement, we will have two things. We will have the external range, which is outside the range, and we will have internal range, which is obviously inside the range, right? Now, if you remember what I said about liquidity, that is where there is money at highs and lows. Therefore, this is external, because if we mark out this high right here, this is outside the move, as well as this low over here would be outside the move, okay? So now we know what external range liquidity is. It's highs and lows, right? And it's the basic version of liquidity. What's fair value gap's role in this, and what is internal liquidity? Now, we've just discussed what a fair value gap is. It's made up of 3 candles when price goes up too quickly without retracing, right? So if we look inside this move, there may be an imbalance or a fair value gap that we need to come back into. By the way, imbalance and fair value gap means the same thing, so don't get confused when I call a fair value gap an imbalance, right? So this would be an imbalance, this would be a fair value gap, whatever you want to call it. This is inside the range, therefore it's internal range. So there's external range liquidity and internal range liquidity, right? And what price does is this 2-step thing. So the first thing price does is go to ERL, right? And then from ERL, it goes to IRL. So the way you can look at this is in one sentence, being price goes from ERL, which is highs and lows, to IRL, which is fair value gaps, right? Simple as that. And then it goes back from IRL to ERL. And you can draw this in like some form of formula, right? So price will go towards IRL, and then it will go back to ERL. It's literally as simple as that. Now, there's one thing that I need to show you about fair value gaps. So what price does is come back to them all of the time, right? 99% of fair value gaps that are formed, price comes back and taps into, right? But there's 2 ways we could react to it. We can respect it, which is just coming up to it and finding like resistance at it and then continuing down. Or there is disrespecting it, which is basically when we have a candle close outside of it. So we push all the way up and treat it like it's not even there. We disrespect it, right? So then we continue up. The same thing can happen with a bullish fair value gap. We can come down and respect it, use it like a support zone, and then continue up. Or we can just go straight through it, treat it like it's not even there, and then continue down. So that's what disrespected and respected means. Respected is when we use it as like a support or resistance. Disrespected is when we just completely ignore it and just go straight through it, right? So now you know what liquidity is, what fair value gaps are, what a respected and disrespected fair value gap is, and what ERL and IRL is. That is the main part of this strategy. The next part is about time and price. So now you know how price moves. You now need to know what good price action is and the right time to trade. So now you know how to trade. You need to be able to trade at the right price action and trade at the right time. So let me show you something called time and price. Now time is very, very simple. Now all you need to do is trade London and New York session. You can either pick one or trade both of them. And if you want to find out the times of these sessions, all you need to do is go and search up London session in whatever time zone you're in, right? Simple as that. Same for New York session. I'm not going to give you a time because it may confuse you. Just search it up, it takes 10 seconds, and you'll figure out what time it is for you. But either way, the right time will always be London and or New York session, right? But what's the best price action? And this leads me on to something I call AMD. Other people call it power of 3. It's basically the same thing. To identify the best price to trade, we look at something called AMD, right? Other people call this power of 3, but it's basically the same thing. So now you know how price works and what the best time to trade is. Let's have a look at what the best price action to trade is. Now, AMD is very, very, very simple. It stands for accumulation, which is a consolidation where price just goes sideways like this. Then the M stands for manipulation, where price is manipulated, which we have a fake out, a quick push outside of the consolidation range, which sweeps liquidity, which grabs all the money so we can fuel the distribution, which is the D part of AMD, which is the big and final move, okay? So this is where we accumulate liquidity, we manipulate price to take liquidity, and then we distribute that liquidity, okay? It's literally as simple as that. And you can think of it like this: consolidation, fake out, reversal, okay? And our job, and what I do on a daily basis, is catch this big move to the downside on stream live every day, right? That's what I do. That's my job. Our job is to catch the distribution move. And what you can break down from this is a very simple concept. After a consolidation, we will have a big move and vice versa. For example, after a consolidation, we have a big move, and after a big move, we will have a consolidation. It's literally as simple as this. This is exactly how price works, okay? It just does this repeatedly forever, right? Now, you know, the best price action to trade is just after a consolidation. We want to try and catch this move, right? The best time to trade is London or New York session, or both. And you know exactly how price works. Let's break down a trade that I took live on stream on the 9th of April 2025. Let's start off by identifying if this is the right time to trade. As you can see, this is 2:50 p.m. You know, we're in the middle of New York session for the UK time, right? Now, right here, you can see we had a massive move to the upside, which tells us what? It tells us that there is a consolidation due just after that, which we started to get. Now, not only did we have a consolidation, but we also swept this key high right over here. Okay, simple as that. So we know that after price takes liquidity, it needs to retrace to a fair value gap, which it did right here. And then after it comes into that imbalance, we then expect price to continue back up to sweep liquidity again. So what we're expecting price to do right now is after this accumulation, we want a push up, sweeping the liquidity, right? Which then gives us the sign of a reversal. Hopefully we get an IFEG, right? And then we can look at catching a big move to the downside. It's literally as simple as that. As you can see right here, we have had a manipulation to the upside, sweeping all of this liquidity to the left-hand side. Now, not only did we have the manipulation, but we also formed a fair value gap inside that manipulation as we swept liquidity. So we know two things. One, price has got to come back to this fair value gap, and two, we're going to have a big move. Now, if we respect this imbalance, you could say that we're going to continue up, but if we disrespect it, which is my entry model, which we close below, we can then look for a distribution to the downside. Now, with this entry, what I did was use liquidity and fair value gaps on the 1 minute time frame paired with that 5 minute time frame bias. So you can see that we swept this liquidity, which meant we were supposed to come into this imbalance. And then when we came into this imbalance, we shown signs of a rejection. So I entered my trade right here, knowing that price had to at least come down and take this low, which meant it was probably going to also inverse this fair value gap. Now, as you can see, that's exactly what happened. So all we have to do is place our stop loss just above here, and our take profit goes at least to the other side of the accumulation. So we're looking at about 2.3 R in a potential gain. We've got a liquidity sweep. We know price needs to come back down. We've had an accumulation, which means we're supposed to have a distribution, a big move, and we have inversed a fair value gap, which means we need to at least come to the other side of this liquidity, which is this low and this low right over here. Let's see how this trade would have played out. As you can see, it was an easy win. And better yet, we had a beautiful take profit because just after sweeping these lows, we went straight up to our stop loss. Now, this trade is in my stream journal, as you can see on the left-hand side. This is the exact trade that I took, right? Now, if you want proof that I actually took this trade, you can go over to my live streams on my YouTube channel, go to the 9th of April, and you can see me take this trade live on stream. So this is exactly how I trade. And if you want to learn exactly how to trade like this every single day, all you simply need to do is go to the first link in the description. I have paid a real psychologist to do a psychology module to teach you exactly how to deal with your trading psychology. Not only that, but I've also paid a fitness influencer showing you how to deal with your mental health and also balance trading with fitness. I am the only person in the industry doing this thing. I don't know anyone else who's paid an actual psychologist to do a psychology module. But if you want to check that out, just go to the link in the description. I'll see you all there. Like the video, comment, and subscribe.